Well, good afternoon, or at least for most of us, good afternoon. Everybody, how you doing? You are here with Mike Shorr. I'm going to be our host today. Welcome to Market Minds. I'm filling in for my good friend and Prosper CEO, Mr. Scott Bauer. Just another ho-hum Monday, huh? Boy, they are really taking it to us. We're down almost 3.4% in the Qs, 2.25% here in the SPY. They're putting the hammer to it. So the interest, we're not here to talk about that, but definitely some fireworks today. A little bit slower right now as we are in the central noon hour here. But what we were going to talk about today is, hang on a second here. Let me get this up here. There you go. We're going to talk about credit spreads. Hopefully this will be, we're going to talk about credit spreads, and hopefully that is big enough for you guys to see. I think it should be over there on the right. All right, so there are, I'll just say, two broad categories of spreads, right? We have debit spreads, credit spreads. Now, there's lots of different types of each of those, but if you want to broadly put them out as two different kinds, so a debit spread, that is a spread that you pay premium or money up front and then settle up when you sell the spread or at expiration. And then a credit spread, same thing, a spread that you receive premium initially and then settle up when you buy the spread back or at expiration. Okay, so we'll take the most basic example, which is a vertical spread. Just a vertical spread. So here I consider a debit spread an active entry. And what I mean by that we believe that something is going to happen. All right? We are going from point A to point B. And then a debit spread, or excuse me, a credit spread, is what I consider a passive, nice typing there, entry. This means that there are multiple scenarios where this spread can be profitable. For example, we are not going below point A or above point B. So there are multiple ways that we can make the money. So typically I'll just say typically we receive odds in a debit spread. because there's only one outcome where we can actually max out the spread. And then in a credit spread, what we're talking about today, I'll just say typically, we lay the odds because there are multiple ways for us to become profitable with a credit spread. Which one's better? Which one's better? I'm not seeing anybody chiming in here. Which one? Neither is better or worse. They each have valid reasons to do them. Just depends on the setup. Exactly. Depends. So, some people say, I'm just a premium seller or I'm just a premium buyer. I think that you are missing half of the coin flip there. There are definitely times where it makes more sense to do a debit spread, and there are definitely times where it makes it more sense to boy, we're really falling out of bed here. Where it makes sense to do a credit spread. So we're going to focus on the credit spread. So for a credit spread, you want either or both a technical level to lean on, like support resistance, and you would prefer that IV, implied volatility, is high, just like anything else. You want to sell high, you want to buy low, doesn't matter. Anything. If you're buying a loaf of bread, if I'm buying it, I want to buy it for as little money as I can. And if I'm selling it down the street, I want to sell it for more than I bought it for. So we see that the VIX is at 23 3/4. Is that high or low? Pretty high, right? If we look at just where, this is a bigger chart so you guys can see it better. If we look at the VIX here. Now, this is a daily chart of the VIX. Let me get this so I can move it properly. This is just a 5-year chart of the VIX. We can see we're on the higher end. There was this spike back up in, what was this, August, right? Yeah, August of 24, where we had that big, huge spike. But really, you take that spike out of here, and this is about as high as the VIX has been for quite a while. The 200-day moving average is right around 17, and we're trading nearly 24. So it's definitely on the higher end. So you're thinking, if I can make it work, at least I have implied volatility working in my favor if I'm selling premium. Now, that doesn't come without risk, but you're on the higher end. And when you're selling options, or if you're selling net options or net premium, you're selling implied volatility. So does anybody have, just looking for an example of maybe something that they're looking to buy or looking to sell? Doesn't matter what it is. Any stock, doesn't really matter. Just as an example. I can come up with one if you guys don't have one. TTD was the first one that we got. All right, so if we're looking at TTD, All right, so I'm going to make this as big as I can so you guys can see the chart okay. Now, it doesn't make a whole lot of sense to me to initiate a short position down here, right? Kind of missed the boat on that. But let's say that we think that there is support for TTD, and let's just say arbitrarily at the $60 mark. Right? This thing was trading before earnings. This thing was trading 125, and it's been cut in half. Just got absolutely smoked. Tesla would be another example. I mean, there's a lot of them out there. But let's just say that we think that we're not going to go below 60, just for an example, in TTD. So what we would do is if we think that we're not going to go below 60, we're going to sell the put. Let me bring this up here. So TTD, our premise is that TTD is not going to expire below $60. And let's just say by the end of the month, arbitrarily. Let's go out 2 weeks. Grab this here. TTD here. All right, so let's go out to, let's just say by the 3/28 expiration. Okay. Everybody with me on that? Make this bigger so we can see the whole thing. So let's say that we are going to sell the TTD 3/28. Let's just say 57.60 put spread. Okay, now are we going to receive or are we going to pay money to do that? So this means that we are going to sell the 60 put and buy the 57 put, which is our protective put. And we receive money. We receive money at the initiation of this spread. And I can pull it up here. We can go out to 3/28 and we'll look at, we're going to sell. I'm going to put it in as a buy and a sell just so the bid ask is normal. So the market on this spread right now is 92 bid, let's just say 90 bid at 115, putting about $1 mid-market. So this spread is trading approximately $1. Okay, and we get this money initially. We get this money. Okay, so now how much can we possibly make on this spread? How much can we possibly make? Right, I don't see anybody popping in here. The most we can make on a vertical spread, credit vertical spread, is the premium collected. Exactly. Or $1. The most we can make. We can't make any more than that. Now, you know me is coming from the risk side of things. How much can we lose? How much can we lose? making money's, that's easy to manage. Okay. We can lose the width of the spread, which in this case is $3, less the premium collected, which is $1. 3 minus 1, I don't even need my calculator for that one. We can lose $2. So we are laying 2-to-1 odds on this spread. Right? Most we can make is $1. Most we can lose is 2. Our risk to reward, 2 divided by 1, equals 2. Everybody clear on that one? So we're laying odds here. But there are multiple outcomes that can still result in max profit. We can stay right here, right? Because TTV is trading $62.03 right now. We can stay right here. As long as we're not below 60, we get to keep that dollar. We can stay right here. We can go up a little. We can go up a lot and still have max profit. That's why we have to lay odds on these types of spreads. Exactly, the time decay, extrinsic value. The worst case scenario is if we are below our long protective strike. We are below at expiration. And we know we can lose, right? We can even, let me bring up here, a little spreadsheet that I have. So we know that we are selling the 60 put, we're buying the 57 put. So we're gonna buy one of these, sell one of these. Right now we're trading 62 bucks. And we are collecting $1 premium. Right? Anywhere above the 60 strike, we keep this. We keep this premium. Anywhere below 57, we know that we are going to net lose $3 because of the width of the spread, but we get to keep that premium. And so we get to, so $3 minus the dollar, we can lose $2. You can see that in any of these scenarios. Where's our break-even point? The break-even point, which I'll just say the BE, is our short strike minus the premium collected. Or in this case, 60 minus 1, right? $59 is our break even. We can put this, I can do a little custom here. So if we go to 59, we know that we're going to lose $1 on these 60 puts that we sold, right? Because if we go out, if we expire at 59, whoever's long these puts, they're going to exercise their right to get short at 60. So we're going to lose $1 on these puts, but we collected $1 in premium to take on that risk. And so net, it's 0. All right, Mike, do we want to get the word of the day out there? Word of the day. Put this out here. Word of the day is credit. Pop that in there. Also, if you're enjoying what we're doing here today, be sure to smash that like button for us. Help us out here. All right, so if you are putting, just put that in there. And Mr. Clark will get you guys on the wheel, and we'll do the spinning of the wheel after this here. So any questions on a credit spread or a different example that somebody would want to use? Or we can just look at different stocks. Do a quick fire here. I appreciate you guys getting that word of the day in there. And be sure to smash that like button. Appreciate it a lot. Now, there are not too many stocks that are up today because we are down 3.4% in the Qs and 2.34 in the SPY. Putting it to it. So in Qs, were you asking about a credit spread in Qs or? So now, if we're looking at Qs here, the big thing that happened on Friday, the SPY's actually rallied back above its 200-day moving average. Qs settled just below its 200-day moving average. Got above it for a little bit, but settled below. And then, of course, we have today where we went out at somewhere around 492, 491.8, something like that. And we're down at 475.30 right now. So now we've lost all the major moving averages. We've lost the 50. We've lost the 200. That's all I have on this chart right now. But the major moving averages, you can see when we lost this 50 in Qs, if we didn't see a rebound shortly thereafter, we knew that this was definitely in play. And now we lost this. Now where are we seeing support? There's not a lot here, is there? We'd have to go to a weekly chart and see. We do have some support here down at right around 450. So about 23 points lower than here. There's not much support. Right now it's still it's holding the weekly ATR, but we are definitely in some peril here. Let's put it that way. So there's not a lot of support. We got a little bit of support here at 448. Like this 440, this 450 area is definitely, if we continue down. Are we going to continue to go down? Well, until the buyers come in and say that's enough, definitely the momentum is to the downside. Let's get back to a daily chart here. So when you're kind of looking for support and resistance and you don't really see anything like we're doing right now, we've taken them all out. Then the next thing you have to do is you have to zoom out to a weekly chart and see where the even longer trend is. Given there's very little support, do I consider a bear call spread? You could. You definitely could. You could say in Qs, I don't think that by whatever expiration that you want to do, that you could say, you know what, we're not going to go back above the 200-day moving average, let's say in the next 2 weeks. So you could do that. So we'll bring up Q's and we'll just say, you know what, for what was that, March 20, I got to remember what was it? It was March 28th, right? March 28th. So if we go out to March 28th here in Q's, so the 28th is here. And if we say that we're not going to go above the 92 strike, we could sell, let's say, the 93 strike. I'm going to need to pull in some more strikes in here. And now they're going to make me go back in here. 28th. If we're not going to go, we're going to sell the 493 strike. And let's say that we're going to buy, let's do a $5 wide one. So, and we'll buy the 98 strike. Now that thing is trading for $1.50. Let's get that spreadsheet back up here. So now that we have Q's trading 474 half, and we're going to buy the 493. This is on the call side. I'm sorry. Clear those strikes out. We're going to sell the 493s. We're going to buy the we're going to sell the we're going to sell the 93s and we're going to buy the 98s. So we're going to sell this call. We're going to buy this call, and we're going to collect $1.50 in premium. Okay, so now we know from our previous example that we know that we can lose $5 on this spread. That's the width of the spread. But we do get $1.50 in premium. So net between the two, the most that we can lose is $5, less the premium that we take in of $1.50, we can lose $3.50. We know that the most that we can make is $1.50. So 350 divided by 150. So here we're laying 2.33 to 1 odds. So that means that in the next 2 weeks, as long as we don't settle at expiration, as long as we don't settle above this 200-day moving average or close to it, we're laying 2.33 to 1 odds on that scenario. Anywhere below 493, we keep the $1.50. If Q's go to 0, we get the $1.50. Our break-even point is going to be 493 plus the premium that we get. So 494 half would be our break-even point. Right? So the upside, if we go to 494 half, we know that we're going to lose $1.50 on these 93 calls that we sold, but yet we took in $1.50 in premium. That's our break-even point. All right, so James, how do you decide when a spread is more beneficial than a buy, when a credit spread? Well, like I said, if you are, one factor is where is implied volatility. We've seen that since August, really the VIX hasn't been higher than this. So implied volatility really hasn't been higher than this since the summer. So you don't necessarily want to, you don't want to buy a lot of premium when premium's high. You want to sell when it's high, you want to buy when it's low. That doesn't mean that you can't make money buying implied volatility here. But you're going against the grain there. And so since what we're saying is that we're not saying that we're going to go rocketing down or, hopefully not rocketing up, because we think that we're not going to be above 493 by the end of this expiration, which is on March 28th. So if we stay here, we keep the $1.50. If we go up, we still keep the $1.50 until we get to 493. The only way that we lose is if we go, the most that we can lose is if we go to 498 or higher. Then we lose $3.50. We go down a little bit from here, still keep the $1.50. We go down a lot from here, still keep the $1.50. So it depends whether you're saying, hey, I think that we're going to go from point A to point B, or if you think that you're saying, I'm just going to take everything off the table except the fact that I don't think that we're going above 493. That's how we make the max amount on this type of spread. Hopefully that makes sense. Does anybody have any questions before I bring up the wheel here? Or any clarifications? A lot of people on the wheel today. I appreciate it. All right. Mike Clark, just one winner today, right? All right. One winner, one spin. All right. Let's give it a roll. Give it a roll. Go. Who do we got? Who do we got? Who do we got? Hey, Rennie. Hey, Rennie is our winner. So, I don't know. Hey, Rennie, if you could email us your shirt size and your address so we can send it to you at prosperswag@prospertrading.com. You're the big winner, Henry. Francisco, how long do I normally stay in one trade? It depends. You have your stop out there. So if it goes against you, hopefully that you are using stops, and then it becomes a matter of management. Maybe we have a big number tomorrow, and you don't know if we're going to go up or down, and yet you still are looking at profit. It's a case by case basis, and that's what risk management really is. Get that out there. Sometimes 1 minute. Well, it depends what type of trade. If we're doing a day trade in Qs, sometimes we're in for 1 minute. Sometimes we're in for 5 minutes. Sometimes we're in for 10 minutes, but they're relatively quick trades. You wouldn't do a credit spread, or for that matter, a debit spread on a day trade. Some people do some types of spread trading on a day trade. We typically do not. But this would be for more of a long-term, not long-term, but like this example here that we're looking at Qs, that's a 2-week trade. Now, we don't have to hold it. We don't have to hold it until expiration. We sell this thing for $1.50 and we keep going lower, and we can buy it back for, let's say, 50 cents arbitrarily. We'll say, you know what? We'll take that $1 worth of profit and move on to the next one. But on a trade like this, I would expect to be in them for multiple days. Like we actually have some credit spreads on right now in this room that I think the folks over in Scott's room have on as well, which we put on last week. And they're still holding up there, which is good. All right. Any other questions? I know I went a little bit long here today, but I want to make sure that I'm addressing any questions or concerns. And always feel free to email me if anybody ever has any questions. My email, I'll give you my email address. I'm Shorr. If you ever have any questions or anything like that, if I don't know the answer, I'll be a little bit surprised, but I will find out who does know the answer. All right, everybody, I want to thank everybody for showing up today. I really appreciate it. I hope you learned a little bit. Like I said, if you like what we're doing here, get all over that and smash that like button. It helps us out on this end. And I will just, hopefully, those of you that are in the STO room with me, I will see you in just a couple minutes. So thank you very, very much. Everybody, good luck. These are tough trading conditions, but that means that there's opportunity. So everybody have a great, great day, great rest of the week, and we'll be checking in with you throughout the week. All right, thanks a lot, everybody. See you later.